Thank you again for giving me an opportunity to discuss the very interesting paper. It's really a nice paper, and I really enjoyed reading it. Is the slides ready for my discussion? Not yet? My slides. I sent the twice before I leave the my country, and I also sent it yesterday. So they are not ready yet. Yeah, I don't have my USB. I have Dropbox, which I can send again. Yeah.
Okay. Yeah, please go ahead.
So my understanding is that I'm a designated discussant for Dr. Lee's paper. And what's the motivation of the paper? Household debt is a major concern in Korea. Now the household debt level is close to 1,400 trillion won, which is about $1,300 billion in US dollars. And that level is the actually, if you calculate household debt to disposable income ratio, it is about 160, which is even higher than that in the US before the global financial crisis. And the Korean government has introduced several macroprudential policies, such as the LTV and DTI, to curb household debt level. And this paper, examines how effective they are. In that sense, this paper is very timely and has very important implications. As she explained very well, there are three major findings in the paper. And first, they find that DTI is more effective in stabilizing housing prices than LTV. And that is actually also stressed in many other studies as well. And the second finding is that there's no asymmetry, so that both tightening and the loosening of DTI are effective. And finally, both the level and the extent of change in LTV are important factors. And those three findings are stressed in the paper. And basically, I have three comments. So the first comment is the why household debts matter. And in the literature, especially after the global financial crisis, many studies emphasize the excessive level of household debts, in the sense that, Glick and Lansing, for example, shows that in many advanced economies, they experience rapid increase in household leverage, and then exactly, those countries experience large increase in household leverage, and then housing prices. So they experience fastest rises in housing prices after this household leverage increase, and then they experience again the biggest declines in the household consumption afterwards. So this shows the kind of the concern, why we have concerns about the this high or sometimes called excessive household leverage. And another important study is made by Mian and Sufi, and this is a book, very nice book about household debt. And they also found that based on U.S. county level data. So this is the just one single country level study, and utilize the cross-section, county level differences. And they found that this increase, so there are some differences across counties in terms of increase in household debt. And they found that this increase in household debt experiences the severity of the downturn after the Great Recession. So the higher the leverage is in specific particular counties, they experience actually more severe recession during the Great Recession. That's the finding. So why is it so? So why these private debts have the negative impact on the economy? And actually, there are two stories, and theoretically we can think of two stories. One emphasizes the demand shock, and if you think that it's the demand shocks for credit drive this kind of the rapid increase in leverage, then probably you cannot explain this negative impact of the household debt or private debts in general, because the rational expectation implies that if you increase your debts against your better prospects in the future, and if that expectations are actually correct, then high leverage actually leads to future income increase, so that you tend to have the positive relationship between private debts and the future output. But if you think that credit supply shocks are the major driver, then actually you can have the negative relationship, in the sense that if the banks have false expectations about the future, and they lend excessively to households with higher risk, then that eventually leads to reversal in sentiment and subsequent low growth. So that I think is the probably explains why we have this kind of negative relationship of the private debts and future output. And this is exactly the justification why the government may want to intervene to curb the some excessive private credit growth. So, but in this paper, actually, Dr. Lee tried to investigate how effective DTI and LTV on housing prices rather than household debts. So my concern is that because in the literature, theoretically or empirically, many people stress the relationship between that level and the future output, then why you focus on prices rather than debts? That's the one comment I'd like to address on the paper. And second second comment is the how effective macro-prudential policies are in general. Many people actually point out that macro-prudential policies are difficult to implement because of the political pressure. In this paper, Dr. Lee shows that actually, DTI and LTV influences if they are implemented on the price level. But my concern is that are they implemented in the right time, in the right place. In Korea's case, I'm not sure whether you heard of the Choinomics. That was introduced under President Park's administration, and that actually loosened DTI and LTV a lot to boost the economy. So they are actually not used for macroprudential purposes. They are actually used as a expansionary policy, one of the expansionary policy. So they actually increased prices and household debt. Are they appropriate? I mean, they are effective in affecting the prices, but it's very hard to from that experience we can conclude that macroprudential policies are effective. And there's other macroprudential policies. This DTI and LTV actually focus on mortgage lending. But there are many, in the previous presentation, we have lots of other macroprudential policies which directly restrict on bank balance sheets. So which are more effective? So that kind of question we have to think about. And another concern is that what is its relationship with monetary policy? Actually, before the global financial crisis, we haven't, seriously considered the macroprudential policies as the financial stability tool. But after, global financial crisis, many people agree that, microprudential type of regulation is not enough. So you need to have some macro view, macro perspective in regulating financial institutions. But so who is the major? The question is that who needs to, what authorities, government authorities, should be in charge of macroprudential policy. In Korea's case, actually, different government authority has actually implemented a macroprudential policy, and the central bank only controls the monetary policy. In this case, because the macroprudential policies have macro impacts, and monetary policy also has some aspect of the financial stability, impacts, so that we need to, coordinate these macroprudential policies well with the monetary policy. But the question is that, is there any, scheme, mechanism to guarantee this kind of coordination between macroprudential policy and monetary policy? And maybe for the sake of time, let me skip the comment 3, which is more specific and technical. And so let me conclude. This is, overall very interesting paper. But I think that, to use the findings in this paper for policy purpose, probably you need to elaborate more on policy implications. And I'm not the person to discuss the Yasu's very nice paper, but let me ask just one question for him. I completely agree with you that the probably household and corporate debts are not major concern in Japan. But yesterday, Professor Kawai asked me actually why corporate debts was a major problem in 1990s when Japan experienced the financial distress. So let me ask you the same question. So what's the difference? So why the corporate debts were a major problem at the time, but not a problem this time? One answer I can think of is that corporations, Japanese corporations, rely on less on loans, maybe more on equities these days. Is that the answer? Maybe I'd like to your opinion. Thank you.